Hello, this is Eric Thompson. I am founder of Peerless Wealth, an investment advisory firm located right here in Columbus, Ohio. As always, thank you for tuning in. I hope you find the following information interesting and useful to your own situation. It is December, so I thought it was timely to talk about how best to give to your favorite charitable causes. In addition to just it being important, all of us, I think, to some level should give something back. Why not do it in the most tax efficient way? If there's tax deductions available, let's get them. That's my philosophy. With that, there are 4 ways, in most cases, only 4 ways that people give to charity. The first is the most common. They write a check out. Maybe they're at church on Sunday. Maybe they go to some sort of charity drive and they write a check. And you might think, okay, yeah, I can deduct that off my taxes. And the answer to that is sort of and maybe. And let me explain that a little bit more. If you itemize your deductions, you fill out something called Schedule A. That means you have enough deductions on that. And those deductions, the big ones are property taxes, mortgage interest, state and local taxes, and charity. If there's enough of those deductions to exceed something called the standard deduction, then yes, you can go ahead and deduct your charitable contributions and benefit from the tax deductibility of that. However, the IRS doubled the standard deduction about 5 years ago. And now for a married couple, it's about $28,000 a year. So for many of my retired clients that maybe have their mortgage paid off, their property taxes, their state and local taxes, and their charitable contributions do not exceed $28,000. So they go ahead and they take the standard deduction. So effectively, they're not benefiting from a deduction from charitable contributions because they're getting the 28. So if you take itemized deductions and you're over that 28,000 as a married and 14,000 single, then yeah, charitable deductions are definitely deductible. If you're doing larger charitable deductions, definitely deductible. So that's the first way. You write a check, maybe you benefit off the deduction, depending on the status of your itemizations versus standard deduction. The second way, you can give all or part of your IRA required minimum distribution directly to charity without it counting as income. Now, this only applies to retirees that are over age 72. Used to be age 70, they just changed it to 72 not a few years ago. What the rule is, if you have retirement accounts such as 401ks and IRAs, if you aren't taking any money out, the IRS says, wait a minute, we know that when you take money out of these, it counts as taxable income. You can't defer it forever and pass it on to another generation. So you have to take a minimum out. So for example, if someone had a $100,000 IRA, they might have to take about $5,000 a year out and count that as taxable income. So if you're a retiree and married and you go ahead and take $5,000 out, you don't need the money, you have other income sources, so you say, I'm going to give that to charity. Write the $5,000 check, go to Schedule A, hey, I can deduct that $5,000. Again, if it's not going to hit that $28,000 standard deduction, it doesn't do anything for you. So what we can do now is we can send that required minimum distribution, all $5,000 or just part of it, directly to your charity of choice. Now that $5,000 doesn't even hit your income tax return, so that is effectively deducting it, and you still get the full $28,000 standard deduction. So that is a perfect way for retirees to maintain the effective deductibility of their favorite charitable contributions. So first way, write a check. Second way, give all or part of your required IRA distribution to charity. Third way, instead of writing, let's say you're maybe higher net worth and you're giving larger amounts, say I'm going to write a $20,000 donation to the American Cancer Society. Go ahead and write the check. Again, you can deduct that because you're probably itemizing your deductions. But a better way to do it is, let's look at your investment portfolio. And I've done this a lot for clients. we can gift highly appreciated stock or other mutual funds or ETFs. We can push the shares over directly to the charity. Charities almost always have a brokerage account that we can push the money over to. So for example, if you put $10,000 in Microsoft stock, now it's worth $20,000. If you say, hey, Eric, sell Microsoft and send me a check so I can donate. Say, okay, hit sell. You've just realized a $10,000 capital gain that you're going to have to pay capital gains tax on. Instead of doing that, we can push the $20,000 worth of shares directly to the charitable account. It's still a $20,000 tax deduction. The charity then sells Microsoft shares. They don't pay capital gains tax because they're a charity. So then you've still deducted it off your Schedule A, assuming you itemize, and you didn't pay the capital gains. So that's the third way, gift highly appreciated stocks or other assets. The fourth way is a little more complicated, and it's typically a case for the higher net worth investor, something called a donor advised fund. I had a client that recently sold their business, and they had, fortunately, more than enough to support their retirement lifestyle. But they were facing a big tax bill in the year they sold the business. And they were also charitably inclined. And so what I told the client is, hey, let's set up a donor advised fund. Let's take I'm going to use an example, $100,000, and we'll put it in what's called a donor advised fund. We're not giving it to charity yet. We're putting it in a fund in which we can dole out the money at any time we want over the rest of his life to whatever charities he wants. Maybe you say, hey, I know I want to give to charity throughout my retirement or throughout my life, but I don't know when or what charity. But what the donor advised fund, it allows my client that $100,000 tax deduction in the year he puts it in the donor advised fund, which is the same year he's going to have a big high income because he's selling his business. So it offsets and really helps him from a tax standpoint this year. So the $100,000 goes into a donor advised fund. We can invest that for growth or conservative, however it's appropriate. And then whenever he wants to donate to charity, he just pulls it from that fund. He says, hey, I want to give $5,000 a year, or I want to give $5,000 this year to XYZ charity. And we just pull it out. There's no tax consequence either way. He already got the deduction. The important thing about that is once you go ahead and set this up and put the money in the donor advised fund, that is an irrevocable gift to charities to be named in the future. You can't take that money back into your name. So that has to be a very well thought out decision because it's rather permanent. So those are the ways to give to charity. So if you're thinking about giving to charity, especially significant amounts, make sure to talk to me, and together we'll figure out the best way to do it financially. And of course, you'll feel good about it as well. As always, thanks for watching and see you next time.